Today I'm going to talk about two relatively new indicators that my dad, Carl Swenlin, came up with, and that is the Golden Cross Index and the Silver Cross Index. Now, most people are familiar with what a Golden Cross is. That is when your 50-day EMA or simple moving average moves above the 200-day EMA or simple moving average. So most people are familiar with a golden cross. That is when your 50-day EMA or simple moving average moves above the 200-day EMA or simple moving average. A silver cross is something that we've coined, and we consider that a positive crossover of the 20-day EMA above the 50-day EMA. So what the Golden Cross and Silver Cross indexes do is they take whatever index, sector, and count up how many have a golden cross and how many have a silver cross. And it's a really great way to get the bias in the intermediate and longer terms. So let's look at a golden cross, silver cross chart. So here is the silver cross on top and the golden cross on the bottom. And this is being recorded around May 25th. So that gives you all of that information. So what we know is that going into this bear market, we started to see the silver cross making a move to the downside. We started to see stocks losing those silver crosses. In the meantime, we were also seeing the Golden Cross Index falling. And so that gave us the heads up that things weren't going so well. And you can see right here at this market top that we had previously, the silver cross began to top, and then you can see that golden cross immediately began to top. Then we look at the participation percentages of the stock above their 20, 50, and 200-day EMAs. By making comparisons of what those percentages are to the SCI, the Silver Cross Index, and the GCI, the Golden Cross Index, by comparing those percentages to those indexes, you can see what the bias is in the short, intermediate, and longer terms. So, for example, we have a short-term bullish bias, a somewhat bullish bias. That is because we have more stocks above their 20-day EMA than we have stocks above their 50-day EMA. So that shows you that there is improvement going on within this particular index, which happens to be the S&P, our benchmark. Now we compare those Silver Cross and Golden Cross indexes to those percentages. So we have a Silver Cross index of 22%, and that is lower than both the amount of stocks above their 20 and 50-day EMAs. So that tells you that we have a bit more of an intermediate term bullish bias. However, when you only have 22% of stocks with a 20 above their 50, that's more of a bearish signal, more of a bearish bias, just simply because of that, the reading. Now, the GCI, we're looking at a long-term bias. We already know that it is bearish because the percentage is all the way down to 40%. But we can further have confirmation of that by looking at the percentage of stocks above their 50 and their 200s. And both of those percentages are below the Golden Cross. So now we have a long-term bearish bias. And that's the information on the Silver Cross Index, the SCI, and the Golden Cross Index, the GCI.